The greatest trap in the market is not the sudden, obvious crash. It is the engineered enthusiasm that precedes it. You are trained, foolishly, to worship the breakout. You are taught to buy aggressively the moment resistance is cleared. You see the barrier fall and you believe the road is clear to riches. You are wrong. You are being played. I assure you, the moment a stock finally punches through that key level with surging volume, that is often the precise instant the large operators are completing their mission. They are quietly selling their entire inventory, their massive accumulated paper, into your eager, hopeful buying hands. You must learn to see the market as a mechanism for the transfer of wealth, not a fountain of opportunity. The professionals do not profit because they are geniuses. They profit because they understand human nature and the necessity of high prices for true liquidation. We are going to expose the most profitable, counterintuitive shorting signal in the entire business, the hidden supply breakout, and we will teach you precisely how to profit when the market support pipeline is finally opened up, releasing months of hidden selling pressure straight into the abyss. This knowledge is dangerous. It requires courage to act against the crowd. It requires conviction to short a stock when every newspaper headline screams of new prosperity. But the profits are staggering. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The understanding of these hidden supply dynamics, such as the one we are about to examine, is usually gained at a high cost, the unavoidable market penalty for ignorance. Fortunately, the essential principles that Jesse Livermore established were meticulously recorded by Edwin Lefebvre in 1923. His foundational work, Reminiscences of a Stock Operator, though presented through the fictional lens of Larry Livingston, is the closest a serious trader can get to navigating the mental training ground of the master. However, the nature of the market has profoundly evolved since 1923. To fully translate and apply this wisdom to modern instruments in psychology, the annotated commentary and context provided by the Max Davidson edition is essential for any serious student of the market. A link to this indispensable edition is provided in the description below. The greatest necessity for any major pool operation is liquidity. If the Composite Man, the great operators, or the investment trusts hold millions of shares of a security, they cannot possibly liquidate that position at low prices. Low prices attract only hesitant buying. They cannot dump their inventory in a stagnant market. They would sink the whole boat before they were half done selling. No. They must execute their plan with cunning and patience. They must build a convincing high-level range. They must create an illusion of perpetual strength. This period is the distribution phase. They use manufactured headlines, minor news spikes, and strategically timed bursts of buying to hold the price up. They cannot risk a major markdown before they are done. Every marginal new high, every small surge past a minor resistance line is simply part of the stage management. You must never mistake marginal new highs for actual conviction. The objective is not to run the stock to the moon. The objective is to hold it steady enough, high enough, for long enough, so that when the final act occurs, there are enough eager, hopeful idiots to buy the rest of their paper. The entire high-level trading range, sometimes lasting months, is merely the preparation for the final, devastating punch. That punch is the hidden supply breakout. The public sees consolidation as gathering strength. I see it as a loading dock, where the operators are patiently offloading cargo. They must keep the lights on and the music playing while they empty the warehouse. Before the true, devastating shorting opportunity arrives, the professional operators execute a final, aggressive push past the major visible resistance level. This move is usually swift, violent, and highly celebrated in the financial press. This final upthrust serves two critical, brutal purposes. First, it sweeps the shorts, the early intelligent shorts, the speculators who correctly identified the high-level distribution months ago. They place their stops just above the visible resistance. This violent spike is engineered precisely to hit those stops. It forces those smart traders to cover their positions, providing a sudden, cheap source of liquidity, buying pressure, that the operators use to finish their selling. The shorts are stopped out just before they would have made a fortune. Second, and more importantly, this violent move lures in the maximum number of late, euphoric buyers. The public is conditioned to chase momentum. When they see the stock finally clear the level that held it down for 6 months, they panic. They fear missing the move. They buy with both hands. They buy on margin. They call their broker and demand the stock, sight unseen. This move, this dramatic penetration of the old wall, is the final act of distribution. It is the moment the last of the pooled shares are transferred from strong, knowing hands into weak, ignorant ones. It is not the initiation of a new trend. It is the closing bell of the party. If you understand nothing else, understand this. The climax of buying is not proof of strength. It is proof of desperation by the operators to sell their final inventory. We must analyze the tape for distortion during this final push. Volume is the confession of the market. It tells the truth when price lies. In a true, legitimate breakout, one signaling real conviction and a new markup phase, volume confirms the move. The initial surge should lead to sustained, easy progress. The stock should feel light. It should sail over the resistance and then trade quickly higher, perhaps pulling back mildly on light volume before continuing. Volume confirms conviction. In a hidden supply breakout, the action is entirely different. Volume is often extremely high on the push to the very peak. But look closer. The price makes shockingly little relative progress, considering the colossal amount of turnover. The stock might move 2 points on 1,000,000 shares, when a true breakout would move 5 points on half the volume. This high-volume, low-progress action is the visual confirmation that new demand is being completely absorbed by overwhelming professional supply at the very peak. Every buyer is instantly met by a professional seller. The move is heavy. It looks like a locomotive straining to climb a hill, but it lacks the internal fuel. It is merely being pushed by the operator's final burst of coordinated bids, just enough to lure in the public. When the price stalls or reverses slightly while volume remains staggering, you are looking at the smoke cloud of massive distribution. The Composite Man is done. He has sold his paper. You must distinguish clearly between the supply wall and the supply pipeline. They are related, but their function is different. The visible resistance line, the clear barrier that the stock has traded under for weeks, that is the wall. It is the obvious psychological barrier. When the price clears the wall, the crowd cheers. But once the price clears the wall and then immediately fails to hold the high ground, the pressure changes entirely. The wall is breached, but the failure to sustain the move confirms it was a trap. The pipeline, however, is the hidden flow. It is the massive reservoir of sell orders held by the large funds, waiting for the structure to weaken. These are the standing short positions, the orders ready to sell on weakness, and the forced selling of margin accounts once the decline begins. When the price dips back below that original breakout level, the point of the wall, it signifies that the pipeline of supply is now open and unobstructed. The buying enthusiasm has been absorbed, and the only force left is gravity, amplified by the professionals who are now aggressively hitting the bids to ensure the price starts its true markdown. The failure to hold the breakout is the moment the market mechanics shift from accumulation or distribution into the markdown phase. Following the initial decisive failure of the breakout, the snapback below the old resistance, the stock will inevitably attempt a recovery. It will try to rally back toward the breakout price. This short, weak attempt is what I call the no-demand rally. You must watch this rally with the utmost scrutiny. The stock attempts to rise back to the confirmed supply zone, the recent high. But observe the tape. It often does so on severely diminished volume. The volume might be half of what was seen on the final upthrust. It moves up sluggishly. It is labored. The bids are shallow. This lack of volume confirms that all available conviction has been exhausted. The enthusiastic buyers who bought the top are now trapped, hoping for a rescue. No significant new professional money is interested in pushing the price higher. They are already short. The no-demand rally confirms two things simultaneously: that the high ground is now a confirmed rejection zone, and that the buying power necessary to sustain a markup is simply absent. It is the last gasp of the bulls, running on fumes before the gravity of the market takes hold completely. This is the point where the weak hands who bought the breakout must decide whether to hold or fold. They are frozen by hope. They should sell, but they refuse. Their refusal simply means they will become forced sellers later at much lower prices. The trigger for the short entry should rarely, if ever, be the exact moment the price reverses at the high. Trying to catch the absolute peak is the quickest way to be crushed by a final irrational surge. Patience is your insurance policy. The critical timing signal is the break of the last significant reaction low within the distribution range. Think of the high trading range as a series of peaks and minor valleys. During distribution, the operators attempt to build support at these minor valleys to keep the overall structure stable. When the price reverses from the failed breakout and then decisively breaks below the last established support point, the last minor reaction low before the final upthrust, that is the moment of structural failure. That break confirms that the internal dynamics have shifted entirely from cautious, controlled distribution to aggressive, intentional markdown. This break confirms that the selling pressure is now stronger than any residual buying interest, and importantly, it triggers the first wave of stops from the late-stage buyers who bought the dips within the distribution range. This structural failure is your official authorization to proceed. The short sale is sanctioned by the tape itself. When the price finally breaches that last reaction low, something crucial happens, leveraging stop hunting as confirmation. The public, who bought the stock believing in the strength of the new high ground, placed their protective stops just under the obvious internal support levels of the distribution pattern. The first aggressive dip below the breakout failure point, and especially the break below the reaction low, triggers these retail stops. This is crucial because a stop order to sell becomes an immediate market order. This sudden rush of forced selling, the liquidation of desperate, trapped buyers, provides immediate, sharp, downward momentum. The savvy short seller recognizes this stop hunting cascade as a major confirmation. The large operators are not merely letting the stock drift, they are aggressively pushing the price lower to intentionally trigger these stops. Why? Because the resulting forced selling confirms the success of their distribution and accelerates the markdown phase, protecting their initial short positions and increasing their profits rapidly. Never underestimate the power of forced selling. It is the most reliable, purest source of momentum in the market. It feeds on itself. The operators know this, and they engineer the descent to maximize this effect. While the break of the reaction low provides the structural confirmation, the safest and most lucrative short entry is often not the initial collapse, but the subsequent retest of the failed breakout level. This is what I call the clean short. The market has a persistent habit of revisiting the scene of the crime. Once the breakout fails, the stock often drops sharply, consolidates, and then attempts a rally back to the area it just failed to hold. This is your opportunity for a minimum risk, maximum profit entry. The failed breakout level, the original wall, has now flipped its role. It is no longer resistance waiting to be conquered. It is now confirmed absolute resistance, acting as a ceiling where professional supply is known to reside. It is the source of the hidden supply pipeline. A successful short position is established when the stock moves back toward this now confirmed supply zone, touches it, and shows immediate rejection. Look for low-volume stalls, long upper wicks, or quick price reversals right at that level. If the stock cannot penetrate the failed breakout price, it confirms without a shadow of a doubt that the supply pipeline is active, full, and ready to flow. Your stop can be placed narrowly, just above the rejection point, making the risk minuscule compared to the potential gain of the ensuing markdown. This retest entry is a gift offered by the market. Take it every time. One must never separate the technical reality of the tape from the psychological reality of the crowd. The two are always coordinated by the great operators. The hidden supply breakout almost always occurs concurrently with the moment of maximum bullish sentiment. Look for the confluence: glowing analyst reports, massive upgrade targets, universally positive sector news, or some great public pronouncement about the future prosperity of the industry. The professionals are meticulous. They utilize this narrative peak, this wave of public euphoria, to ensure that retail buyers are maximally engaged. They need the crowd to believe the story is real so they can liquidate their positions unimpeded. The story justifies the price action for the novice. The true speculator must possess a deep, abiding skepticism. You must distrust obvious enthusiasm. You must trust the cold, hard price action and volume over the optimistic headlines. The story is fabricated to mask the operation. The fundamentals often catch up to the chart too late, usually after the price has already been cut in half. When the chart shows you colossal volume without proportionate progress at a high level, and the papers are singing hymns of prosperity, prepare to short. The divergence between euphoria and tape action is the flashing signal of impending markdown. Once the market pipeline is truly open, once the professional selling has triggered the initial cascade of stop losses, do not interfere with the move. The true reward from shorting the hidden supply breakout comes not just from the initial decline, but from riding the momentum of open supply. The movement will feed itself. Trapped buyers, realizing they are utterly ruined, will be forced to liquidate their margin positions as the stock descends. Their liquidations generate more forced selling. New, aggressive short sellers will pile in, recognizing the structural failure. The banks will start calling in collateral. This chain reaction accelerates the decline far beyond what the initial selling pressure might suggest. The momentum of open supply is governed by the inevitability of liquidity flowing to the point of least resistance, which is now decisively downward. Do not be tempted to cover your short position at the first minor rebound. Learn to recognize the sheer inertia of a market that has completed a full distribution pattern and is now in the throes of a markdown. Hold your position until you see objective signs of accumulation or exhaustion volume. The market pays you handsomely to be skeptical. It pays you to distrust obvious enthusiasm. It rewards those who understand the unseen machinery of large-scale operations. Most traders, the fools who rush in with the crowd, see the breakout as opportunity. They see the surge of volume and they see only profit. You, the speculator, must now recognize it for what it is: potential liquidation. The next time a stock bursts past its resistance, do not rush in with the crowd. Do not be drawn into the final, desperate act of the operators. Step back. Wait for the failure. Wait for the snapback below the old resistance. Confirm the hidden hands are selling. Watch for the no-demand rally back to the failure point. And then when the structural support breaks, when the pipeline is confirmed open, prepare to profit. Profit when the market washes the foolish buyers away in a sudden, brutal flood. The entire business is nothing more than observation, patience, and courage. These are your only true assets in this endeavor. Use them and you will survive. Use them and you will thrive.